So now we are discussing fear and greed in financial market. So greed and fear refer to two opposing emotional states theorized as factors causing the unpredictability and volatility of the stock market and irrational market behavior inconsistent with the EMH, which is the efficient market theory. So once again reiterating, EMH is basically that theory which says that if a stock is listed on X price, then that X price is the fair value for that stock. Any recent information, news, corporate action, anything which has happened in recently has already affected that price, and that price which we are saying is the fair value price. So this is what the EMH theory states. So greed and fear relate to an old Wall Street saying. So there is an old saying that financial markets are driven by two powerful emotions, greed and fear. Greed and fear are among the animal spirits that were identified profoundly affecting economies and markets. So Warren Buffett have also found one thing, found an interesting rule that in acting contrary to such prevailing moods, advising that the timing of buying and selling stocks should be fearful when others are greedy and greedy when others are uh, fearful. He uses the overall market capitalization to GDP ratio to indicate relative value of the stock market in general. Hence, this ratio has become known as the Buffett indicator. So, we have discussed what is the Buffett indicator. So, the overall market capitalization to GDP ratio, which indicates relative value of the stock market in general. So, this is known as the Buffett indicator. Now, firstly, we'll talk about greed in detail. So, greed is usually described as an irresistible craving to possess more of something, money or material goods. So, if I want to acquire something, if my utility for a certain thing is very high, then that maybe comes under the greed. Then it should be greater than the actual quantity what is required. So, suppose I need two breads per day to keep myself going, but I like that bread very much and I'm going striving for 6 to 10 breads. So that is my greed because that is not my requirement. I'm actually aiming for it. I'm actually striving for it, even though I don't require it. So that will fall under the greed category. According to several academics, greed has the power to send a chemical rush through our brains that forces us to put aside our common sense and self-control and thus provoke changes in our brains and body. However, there is no general accepted research on physiology of greed. Other academics tend to compare greed to an addiction because greed, like smoking and drinking, can illustrate that if a person can take over one's addictions, it is possible to avoid bad effects from resisting it. On the other hand, if one cannot resist its temptations, he can easily get swept away by it. In other words, it can be deduced that certain traders who join the business world for the emotional agitation and desire of hitting that emotional high are addicted to the release of certain brain chemicals that determine those states of happiness, euphoria, and relaxation. Before mentioned fact can also simply imply that such traders are susceptible to all addictions. Furthermore, humans' brains are naturally activated by financial awards, which, in the same way as drugs, produce an incredible but perilous feeling and thus an addictive experience. One of the most common examples of situation is the dot-com bubble, which happened in 1990s. It was also known as the internet bubble. So the speculative investment bubble that was created around new internet startup companies in the years 95 2000. In that time, exorbitant prices of new internet companies motivated investors to invest into the companies whose business plans included a dot-com domain. Investors became greedy, creating further greed, resulting in securities that heavily overpriced, which eventually created a bubble. So this is the greed. Now we'll talk about fear. So emotion of fear is usually characterized as an inconvenient, stressful state triggered by impending peril and awareness of hazard. Internet bubble is not only a good example of fear investors greed, but also the period following the bubble can serve as a good characteristic for the fear that was induced in the market. In pursuance of solutions to suppress their losses after the internet bubble crash, fearful investors decided to swiftly move out of the stock market, concentrating their attention on less uncertain purchases, spurring their capital into market securities, stable value funds, and principal protected funds, all of low risk and return securities. Such behavior is an example of a complete negligence of long-term investing plan, which is based on fundamentals. Investors disregarded their plans because of the fear of committing persistent losses, which identically did not bring any profits and benefits. So what we are seeing here, that a bubble was created and people were just in the herd mentality, if we can say it. So in because of that mentality, they were just putting their money in some of the few stocks. Ultimately, when the bubble crashed, so they experienced losses. And then again, because of the fear, they started investing in very stable instruments, which had without any long-term planning and all. So they were basically targeting this time the low risk and low returns investment schemes or some other instruments. Ultimately, they are doing the one other mistake. So they are trying to cover up their first mistake by making one other second mistake. Both of the things were affected by behavioral finance. And if we can say that if they would have researched properly, they would have taken rational decisions, then this might have not happened. Now we'll discuss about hope. So some academics disagree with the notion that greed and fear are main emotions driving these financial markets. So according to Lola Lopes, which the famous psychologist. So while fear is indeed a crucial driving financial markets, majority of investors don't respond that much to greed, but to hope. It indicates that fear, unlike hope, provides investors to concentrate on unprofitable invest, while hope does not complete opposite. Furthermore, hope and fear are believed to alter the manner in which investors estimate other possibilities. Fear provokes investors to ask, how bad can it be? Can it get? While hope will say, how good can it get? In this case, fear drives investors to enhance security, while hope stimulates investors to emphasize potential. So basically, hope helps us to drive in the positive direction. It helps us to stimulate investors to emphasize the potential rather than focusing on the securities. One tool is used to measure this volatility, which is CBOE volatility index. It was elaborated by Chicago Board Options Exchange in 93. In other words, it can be defined as a sentiment ratio of Wall Street's fear to greed gauge. It is usually used by traders to check the grade of investor complacency and market fear. Uh, in practice, it is also called as the fear index. So in case of increased index, investor sentiment leans towards higher volatility, which corresponds to higher risk. If the reading of this index is under 20, it usually indicates that investors became less concerned. However, if the reading exceeds 30, it implies that investors are more fearful because prices of the options increased and investors are more prone to pay more to preserve their assets. Now we'll talk about the emotions which are there in the financial market. We'll talk about the relation. We'll talk about the decisions, goals, theory, and relationship. The hope, anticipation, and pride. How can fear uh, can converts to anxiety, and finally it can converts to regret in the decision. So we'll talk about all this. So emotions and financial markets. So emotions can be defined as a physiological state of arousal triggered by beliefs that something defines as a motion, the felt tendency toward anything intuitively appraised as good or away from anything intuitively appraised as bad. So If something is good, I'm going towards it. If something is bad, I'm going to in the opposite direction. So this will be triggered by my emotions. A strict definition of the term is complex because emotion has cognitive, physiological, social, and behavioral aspects. So a particular definition is quite difficult to provide. Despite the lack of a definition for emotion, there is an agreement on the set of emotions that exist. In 1998, Elster uh, has stated that some states are clearly emotions, including, for instance, anger, hatred, regret, fear, elation, joy, love, guilt. These are clearly the emotion. He has further argued that these emotional states can be differentiated from other mental states on the basis of six features. So these features actually do not provide a complete definition of emotion because not even one feature is an element of every emotion. Yet these six features remain central to current discussion and provide a framework for understanding what an emotion is. So we'll now discuss all these six features. So first will be cognitive antecedents. You can write down it is cognitive antecedents, ANTECDNTS. So emotions are triggered by beliefs. An investor regrets an investment decision because he or she believes that bad outcomes could have been avoided. The second is intentional objects. So emotions are about something. The object of an emotion is usually the cognitive antecedent. For example, the poorly performing investment is the object of the regretful investor. Third is physiological arousal. So changes in hormonal conditions and the autonomic nervous system accompany emotions. The regretful investor may feel pangs, a hollow stomach, or depression. Next is valence. So emotions can be placed on a scale with a pleasure at one extreme and pain on the other. So valence is the experience of pleasure versus pain, translates to happiness and or unhappiness. The regretful investor is decidedly unhappy about the poor investments outcome. The fourth one is physiological expressions. Observable expressions characterize emotions. Facial expressions, posture, voice intonation, and outward appearance are noteworthy. The regretful investor may appear pale and slumped shoulders. The next is action tendencies. So emotions are associated with a tendency to act. The regretful investor might take actions to avoid being exposed to similar investment opportunities. Invest Emotions have a bearing on risk tolerance, and risk tolerance influences portfolio selection. Investors experience a variety of emotions as they consider alternatives, decide how much to take risk, watch their decisions play out, assesses whether the initial strategy needs modification, and finally learn how far they have succeeded in achieving their financial objectives. So now we'll see the relationship between hope and fear, if and pride and regret. So if we can see, I have placed hope and fear under one line on the left hand side, then it is anticipation and anxiety, and on the right hand side, I have written pride and regret. So investment decisions lie at the left end of the line of where which I have written, and investment goals at the right end. So according to the psychologist Lola Lopes, investors experience a variety of emotions, positive and negative. Positive emotions are are above the are in the second line which I have written, which is the hope, anticipation, and pride. And the negative emotions are in the last row, which is fear, anxiety, and regret. So on the positive side, hope becomes anticipation, which finally converts into pride. On the negative side, fear turns into anxiety and finally transforms into regret. Hope and fear have a bearing on how investors evaluate alternatives. Fear induces investors to look at the downside of things, whereas hope causes them to look at the upside. The downside perspective emphasizes security. The upside perspective focuses on potential gains. So basically, if an investor wants to focus on the gains, then hope investor should see the second row, which is the hope, anticipation, right? And if that person is focusing on the last thing, which is fear, anxiety, and regret, then that will come under the negative side. Now we'll move on to the next topic, which is behavioral corporate finance and GMS, which is geomagnetic storms and investor psychology. So this is our last two topics we'll discuss, and then we'll come to the conclusion of behavioral finance. So first we'll talk about the GMS, then we'll end our session with the discussion on behavioral corporate finance. So GMS is geomagnetic storms and investor psychology. So the geomagnetic storm, which gives rise to it has been related to that beautiful northern lights, which are very short-lived in disturbance because of the disturbance in the Earth's upper atmosphere and magnetosphere. So basically, that GMS storm is we have seen this GMS storm, and what are the effect of GMS storms on the financial market or the investor psychology. So we'll try to identify a relationship between that also. We have already discussed the relationship of calendar events on the investor psychology. Now we are discussing about some other factors as well. So basically, we are actually seeing that how diverse this behavioral finance is. Like, each and everything can be related to the behavioral finance. So it it might seem to you that how why I'm introducing this GMS storm and everything in middle of the course, but I'm just trying to show you that each and everything can be related to the behavioral finance. So we'll just quickly discuss about the GMS. So geomagnetic storm, which gives rise to beautiful northern lights, is a short-lived disturbance in the Earth's upper atmosphere or Earth's magnetosphere. It is caused by solar flares or solar winds that is intense explosion from originating the visible segment of the sun's chromospheres, which disturbs magnetic field. These solar flares are known as plasma, which is made up of electrons and protons with the energy of Earth of some thousand of electron volts. Disturbance. So storm time DST is the index which tells about the changes in the geomagnetic storm. The disturbance storm time index calculates approximately the worldwide average modification in the horizontal module of Earth's charismatic field at the equator, and the measurements are done from different magnetometer stations. Disturbance storm time is calculated in every 1 hour and its description is given in close to real time. During normal days, disturbance storm time is between +20 and -20 nanotelsar, which is the unit. Now, what is the objective? So, to determine how geomagnetic storms impact everyday returns of capital market, deviation in the average return and change in investors' strategies, we'll also see that how it will determine the effect of geomagnetic storms on people's moods. So we'll also see the impact on people's moods as well as on the capital market while relating to the decisions, opinion, and behavior of the people. Now, first we'll discuss what are the phases of the geomagnetic storms. So the phases of geomagnetic storms are basically divided into three parts. First is initial phase, main phase, and recovery phase. So initial phase of geomagnetic storm is illustrated by the disturbance storm time. Most of the geomagnetic storm does not have an initial phase, and there is no unexpected increase. The initial phase of geomagnetic storms is also known as storm sudden commencement. The phase is connected by means of density of the magnetosphere, which results in an enhance in local strength. The period of this phase can be up to 2 to 8 hours. After this comes the main phase. The period of main phase of geomagnetic storm is about 12 to 24 hours. The main phase is about decreases in surrounding field intensities. In this phase, geomagnetic storm is characterized in the terms of disturbance storm time. Typically, it is less than minus 50 NT. NT is the unit for measuring this, which is nanotesla. Typically, the lower bound of values during the course of storm is said to be in the range of minus 50 to minus 600 NT. Lastly comes the recovery phase. This phase ranges from 10 hours to as much as 7 days. This phase results from reconciliation between the lower and bound and normal range of storm time. So basically there are three phases. So the initial phase lies up for the 2 to 8 hours. The main phase is for 12 to 24 hours, and the last phase is typically from the 10 hours to 7 days. Now, what is the relation between GMS and investor psychology? So there is a growing attention in the enterprise of psychological sciences towards the measurable effect of high intensity of geomagnetic activity and psychological states of those experiencing it. So surely this area remains underexplored at this point in time and merits attention from both psychologists as well as behavioral economists. For instance, geomagnetic activities that have been speculated to be associated with differing mental states of confusion as well as higher alert levels. And such mental states certainly contribute to how people process information, evaluate alternatives, and make financial decisions. For instance, one potential way this effect may manifest is as follows. So investors under the influence of geomagnetic storms, if they tend to become distrustful, such a mental state may influence their trading behavior. Thus, we can make a case for a systematic association between GMS and investor behavior. For instance, there are documented cases of returns from investments which are going down during strong geomagnetic activity. Whether or this association is casual or just correlational in is contentious. So, rigorous experimental designs are required to establish any effects of geomagnetic storm on small capitalization or to establish any relationship between the two. Moreover, it also has been documented that the relative effects of geomagnetic storm on small capitalization capital is more in magnitude compared to the on the large ones. In 2001, Gompers and Metric, so they noticed a marked difference in effects of geomagnetic storms in individual versus institutional investors in that while influence on individual investors was more, on institutional investor, it was relatively less. So we can form a hypothesis to explain this, whereas individuals tend to be affected by such emotions as fear, anxiety, and greed. The institutional investors play mostly by established and time-based tested rules, leaving little chance for emotions to come into play. So institutional investors are basically playing a safe game here. The findings concentrates on the idea that GMS have conspicuous influence on evaluation of small cap capitals, which in turn influence the issuing of financial decisions of the investors. So this is how various studies have been conducted, that what are the effects of GMS is there on this investor psychology. So we have seen that it more uh, uh, affects the behavior of the individual investors rather than the institutional investors. So institutional investors are playing more rationally. They have a time tested rules and they are playing accordingly. But the individual investors are backed by the emotions, hence they are in a much more um, difficult state as compared to the institutional investors. Now we'll discuss the final topic of our um, series, which is behavioral corporate finance. So we'll see what are firms, investors, and third parties. We'll also see the perspectives in this, which is the biased investors, biased managers, and biased third parties. So now we'll discuss the behavioral corporate finance. So now when we are thinking about a firm's financing and investment decisions, rational executives are guided by a belief in the efficiency of markets. But what if markets are not as always efficient as we believe they are? And what if executives themselves are not rational and rational decisions are biased in some predictable way? So what if this happens? This second question, central to research in a new academic discipline. So this question is basically answered by behavioral corporate finance, that the corporate decisions which are always seem to be more cognitive driven, more rational driven, what if they are affected by the behavioral finance? So this topic will answer that queries. So this behavioral corporate finance forces us to re-examine conventional ideas about corporate finance and compensation strategies. Behavioral finance integrates psychology and economics, which we have already understood in our previous slides, into the study of human judgment and biases in decision making under conditions of uncertainty. The research in behavioral finance, behavioral corporate finance takes two distinct approaches. The first emphasizes that investors are less than fully rational. It views managerial financing and investment decisions as rational responses to securities market mispricing. The second approach emphasizes that managers are less than fully rational. It studies the effect of non-standard preferences and judgmental biases on managerial decisions. So basically, this reviews the theory, empirical challenges, and current evidence pertaining to each approach. Overall, the behavioral finance approaches help to explain a number of important financing and investment patterns. So two general insights have emerged from behavioral corporate finance research on the high level decision maker. So first insight is that the evidence on biased behavior of smart and talented professional implies that successful fixes of biased decision making will need to be of a different nature than implied by the earlier emphasis on education and financial literacy. While the second insight uh, tells us that the behavioral researchers should consider carefully behavioral researchers should consider carefully which biases are plausible on which individual is in which setting, rather than testing them uniformly in the convenience sample. Being confronted with the objection that successful CEOs surely won't be biased, or concerns about the seeming inconsistency of considering investors bias in one paper and managerial biases in another. Researchers in behavioral corporate finance had to think hard about the type of biases that are plausible for decision makers in a corporate setting and how they differ from those considered for the untrained individual. Now we'll see what is corporate finance and behavioral corporate finance in a bit different way. So corporate finance seems a misnomer for the type of research presented at modern corporate finance conferences. And it is very far too narrow. So the firms, we can see I have written here firms, investors, and third parties. So the firms that are not incorporated, so entrepreneurs are there, analysts and households all making decisions far beyond their financing aspects. So a firm seeks financing from outside investors, basically, and has to overcome two hurdles: moral hazard and adverse hazard. So firm, I'll talk about the firm. So firm will have people who do not have their own mindset for decision making. They'll need some advisors who seek help from the outside investors. So firm seeks financing from outside investors and has to overcome two hurdles: moral hazard and adverse selection. Moral hazard concerns incentive misalignment between managers and investors. So for instance, a manager may choose to expand the firm due to private benefits. even when such expansion is not profitable. This incentive conflict affects the firm's ability to obtain financing when investors cannot observe and control managers' behavior. Adverse selection concerns a different type of asymmetric information, namely that investors cannot distinguish promising and less promising investment opportunities. As a result, a firm can fail to obtain financing for an investment period, even when it would be profitable to the investors. The firm may resort to signaling via dividend payments or to a packing order of financing choices in order to overcome these frictions. Now the firm has the moral hazard and corporate governance. So in a firm, there will be CEO, managers, board of directors, employees. So moral hazard will be for everyone from CEO to the employees. At the same time, corporate governance will be from the board of directors to the CEO and managers, but not will be related to the employees. Now, third parties will have influence on both the firm as well as on the investors. So investors, if I'll say, so they will be the shareholders, commercial banks, outside investors, etc. So corporate governance will have a role on the shareholders as well as on the commercial banks. So this will be that thing. So moral hazard can play a role between the corporate governance and the shareholders, while adverse selection will play a role between the corporate governance and the adverse selection and the commercial banks. While the third parties will have analysts, investment banks, rating agencies, regulators, and central banks. So they will play a role with both firms as well as with the investors. So now there will be three type of perspectives. So behavioral corporate finance, which applies tools and insights from behavioral economics to corporate finance settings. So behavioral economics as an approach that allows, there will be three perspective for this. First will be biased investors. Second is biased managers, and third can be the biased third parties. So biased investors, biased managers will come under the firms, and investors I've already written there, and biased third parties can be there for which can affect the decision making. So we'll take the first perspective that the investors are biased. So perspective one will analyze the interaction between investors that exhibit a non-standard behavior and rational managers. Now in this first case, managers are rational, but my investors are biased. So it will explain the corporate finance policies that have been hard to reconcile with standard neoclassical models as the managerial response to the investor biases. This explains several important styles facts in corporate finance, most of them revolving around the type of financing choices by managers. Other puzzles of seemingly non-standard managerial decisions remained unexplained, such as patterns of investment cash flow sensitivity, the strong path dependence of capital structure, and the heterogeneity in financing patterns among otherwise similar firms. This observation was the starting point of the behavioral corporate research performed from the perspective of biased managers. Second can be the, now first one was managers are rational, but investors are biased. Second one will be managers will become biased. So behavioral corporate finance considered biases on the side of the manager. Here the question is whether non-standardized managerial behavior and the market's response to it helps explain existing puzzles in corporate finance. The managerial biases considered include overconfidence, reference dependence, experience effects, and more generally traits that are not relevant in traditional models. The response of the market is generally assumed to be rational. The manager aims to maximize own or existing shareholders' wealth but fails. Due to the manager's biased perspective, it ends up maximizing perceived wealth. The chosen actions that seem optimal under biased beliefs might not be optimal given to the true probability distribution. As a result, it will not maximize true objectives. So these welfare considerations are a key reason for why researchers should aim to go beyond rational, as if models for reasons of modeling discipline, when in reality, behavioral biases may be at work. Now, the third one will be the biased third parties. So many corporate finance settings feature a third group, most frequently financial intermediaries or analysts, who may also display non-standard behavior. So this could be in turn affect corporate decision making. So they provide evidence that credit analysts are often biased in assessment of borrowers, and that these differences in assessment carry through debt crisis. Corporations need a lot of improvement in some of these aspects. We're referring to management and corporate governance, sensible incentives that mix the personal interest with corporate risk and reward control and communication systems, risk management systems, accounting standards, and procedures of human resources. So as investors, we need should take in consideration aspects like dividends, earning announcements, and the evolution of closed and funds industry in order to understand better the investors and the market sentiment, the price momentum and price reversal, so we may increase further our benefits and our wealth. So these are three of the perspectives which were given in this behavioral corporate finance, that investors can be biased, managers can also be biased, and the third parties who are actually assessing the financials of the companies, they can also be biased. So it also explains. So basically, now we come to the end of our course on behavioral finance. So behavioral finance, if I'll reiterate, uh, it is the combination of psychology and economics. It is more uh, dependent on our emotions and our intuitions, and it is less dependent on the um, cognitive behavior of an individual. So this was the behavioral finance course. We have also seen how behavioral finance is affected by the outside factors, which can directly or indirectly affect the thinking of an investor, and how that investor's feeling will ultimately comes into play when while trading or while in a stock market, uh, uh, playing in the stock market. At the same time, in this in this course we have covered quite a lot of topics. Each topic might not be related or relevant to each and every individual. So while going through this course, your first aim should be why you are learning behavioral finance, because this topic is useful for the people who are doing their undergraduation, the people who are using in the stock market, the people who are in the higher education. So this course can cater the requirements of each and everything and every individual. This course is also quite exhaustive. It is not limited to certain few topics or formulas which we can just discuss and find the example. This is more of a theoretical course. So I've tried to cover the at max theories, principle, concepts in this. But yes, the topic is still into research. New definitions are coming up time to time in this behavioral finance topic. We have already seen that the initial definition was started in 1912, and till now it's 2024, it is into research, and many other factors are trying to identify, people are trying to identify, which are affecting the behavioral finance. So this is quite exhaustive in detail. So Now, I'll just finish this course. So I hope you like this session. So please enroll in our course. And if you have any queries, you can reach out to us directly or through our website in the contact us session. You can also follow us on the LinkedIn, Insta pages. So my name is Rohit Khimchandani and I have prepared this course. So you can approach Uplatz or directly to me if you have any queries regarding this course. So I hope you enjoyed this session. Thank you so much for your time. Thank you.